SpaceX just shed over 50% of its market value. That historic peak after the June IPO has completely vanished. The stock crashed from $225 down to $108. Retail investors are panicking across the globe today. Wall Street is bracing for absolute market chaos right now. Tomorrow brings the very first public earnings report in company history. Traders expected a smooth ride straight to the stars. Instead, harsh gravity hit the share price hard. This is not just a random market blip. It represents a major reality check for modern aerospace valuation. People bought into the massive hype surrounding Elon Musk's company. They completely ignored the underlying balance sheet realities. Financial reality is setting in faster than a booster reentry. The market reaction today shows deep underlying anxiety. Traders question if a $1.5 trillion cap makes sense. Revenues are growing rapidly, but so are the financial losses. Capital expenditures are skyrocketing into tens of billions of dollars. Investors suddenly remember that public markets demand actual profits. Private companies can hide behind venture capital funding for years. Public markets demand absolute transparency every single quarter. That cultural clash is why this sell-off has been so brutal. Let's look closely at why this happened right now. The initial public offering created an unsustainable valuation bubble. Early institutional backers rushed to secure quick profits. Insider lockup expirations are looming on the immediate horizon. That looming supply overhang creates massive downward price pressure. Every professional trader saw the writing on the wall. Retail buyers were left holding an expensive bag. The correction was mathematically inevitable from day one. What most people don't know is that the valuation math never truly added up. When SpaceX debuted at $135, intense FOMO took over. The stock rocketed past double digits in days. Traders piled in blindly without looking at fundamentals. They chased the artificial intelligence narrative hastily attached to Starlink. Wall Street analysts tried to justify a multi-trillion-dollar cap using futuristic projections. However, fundamental financial data told a very different story. Quarterly revenue hit roughly $6 billion, but net losses widened. Cash burn is accelerating at an alarming, unprecedented rate. Building out global satellite networks costs an astronomical amount of cash. Starlink average revenue per user has actually dropped over time. Cheaper international service plans diluted the initial high profit margins. At the same time, short interest climbed to staggering heights. Institutional short sellers smelled blood in the water. They initiated massive short positions ahead of tomorrow's earnings drop. Retail traders got caught squarely on the wrong side of momentum. When momentum stocks break, they break with extreme violence. Support levels completely evaporated overnight in heavy trading. Panic selling triggered automated stop-loss orders across brokerages worldwide. Traders in New York, London, and Frankfurt watched portfolios bleed red. The market mood shifted from unbridled optimism to extreme caution instantly. This brings us straight to the global ripple effect. The shockwave did not stay contained within American borders. Global space stocks took a severe beating alongside SpaceX. In the United States, Rocket Lab slumped hard. AST SpaceMobile saw devastating double-digit percentage drops. Intuitive Machines crashed right alongside them in sympathy. Across the Atlantic, European satellite operators felt immediate pressure. France and Germany saw heavy selling in aerospace equities. London-listed defense and tech portfolios experienced painful collateral damage. Global investors pulled capital out of the entire space sector simultaneously. When the undisputed giant of an industry sneezes, everyone catches a cold. European suppliers providing specialized components for launch hardware faced immediate selling. UK institutional funds trimming risk-cut exposure to anything speculative. The correlation across the global board was staggering. Every major space equity topped out during the exact same week. Then came the synchronized downward spiral across multiple exchanges. This was a classic institutional liquidity flow event. Big funds were rebalancing their portfolios globally. They sold high beta space assets to lock in safe cash. Retail investors mistook this systematic deleveraging for company-specific failure. They dumped shares at the absolute worst possible moment. Understanding this difference is crucial for smart portfolio management. Let's pause right here for an important message. Before you skip to the end, you need to understand who is buying these dips. While retail traders panic and sell, smart money is watching closely. Institutional desks are positioning themselves for tomorrow's earnings catalyst. Before we break down those exact trade setups, hit that subscribe button right now. You cannot afford to miss tomorrow's market open breakdown. Subscribe to the channel to stay ahead of global financial trends. Do it right now so you never miss a single update. Now, let's examine what the institutional players are whispering about. Most retail investors look only at headline loss numbers. They see a 50% drawdown and assume the business is failing. Professional traders look at alternative data signals instead. Job postings at SpaceX are sitting near all-time records. Hiring velocity has actually accelerated by over 40% recently. Capital expenditure commitments remain completely intact and robust. Infrastructure spending is ramping up, not slowing down. That tells a completely different story behind closed doors. The company is aggressively expanding its core operational capacity. They are pouring billions into next-generation Starship development and data compute. The long-term technological vision is undeniably massive. However, short-term earnings pressure is terrifying traditional value investors. That clash between long-term vision and short-term survival creates extreme volatility. Volatility is precisely where professional traders find their edge. Let's look at how you can trade this setup safely. The surprising part comes next in our analysis. Tomorrow's earnings report could trigger an explosive short squeeze. Short interest is sitting at over 70% in related assets. If SpaceX reports revenue above Wall Street consensus estimates, watch out. Any positive surprise regarding Starlink subscriber growth will shock bears. A short squeeze happens when trapped sellers scramble to buy shares simultaneously. That sudden buying pressure causes the stock price to spike vertically. However, the downside risk remains equally terrifying for bulls. If artificial intelligence revenue metrics fall short, the stock could plummet. The price-to-sales ratio remains elevated above 50 times sales. That is still exceptionally expensive compared to traditional technology benchmarks. How do you trade this setup safely as a retail investor? Do not gamble your entire portfolio on a single binary event. If you want exposure, wait for dust to settle after market close. Look for a confirmed stabilization pattern on high volume. Alternatively, use defined risk options strategies rather than outright stock purchases. Protect your hard-earned capital above all else. Markets can remain irrational longer than you can remain solvent. Let's wrap up everything we learned today. SpaceX's massive market dip is a textbook lesson in valuation reality. A brilliant engineering company does not guarantee an underpriced stock. Public markets demand actual profits, steady cash flow, and transparency. The global ripple effect proved that space is a correlated asset class. US, UK, and European markets all reacted in unison today. Keep a close eye on tomorrow's earnings release after the bell. Manage your trading risk tightly and avoid emotional decisions. Look out for our next video posted daily to keep your edge sharp. Thanks for watching and see you tomorrow.